Okay. Now let's try to understand about solvency ratios, in which one of the key ratios is our debt to equity ratio. This ratio simply tells us about how much total debt we are having within the company, and compared to that how much equity is there, which means what are your external liabilities for debt versus what are your internal equity shareholders total value. And this is a key ratio. So if we go and see within our P&L and balance sheet above, so this is our P&L and balance sheet, wherein we can see that our total equity here is $270 and our total liabilities, which includes our current debt of 100 and long term debt of 150, the total of both of them is 250. So our total liabilities are 250 versus our total equity is 270. So if we go below and try to see how does this impact and what is our debt to equity ratio, so that will be just here. So our total liabilities was 250 and total equity was 270. This simply gives us 0.9 times, which tells us that if we are having our equity of $1, we are having our liabilities of 90 cents. So the efficiency of business is being shown by this ratios as well. Now why the companies use it? Because they use it for financial risk. If this ratio is higher, which means the company is reliant on more debt, which means higher risk. For example, if any company is having 3 by 1, which means they are having equity of 1 but the debt of 3, so high risk, high debt is there. Capital structure decisions can also be taken, that how much funding should be taken from debt or how much funding should be taken from equity. Investors take the insights for them, that how much risk is there, they can check it before giving additional investments, or banks also check it before giving the loans, and we can compare with the other industry and benchmarking with as well. Now if we see some real world examples, so Apple Incorporation has taken significant debt despite huge cash reserves. Why they have taken significant debt despite huge cash reserves? Because debt financing is cheaper. When you go and take the debt, you can get it from 7% to 15% interest only. However, generally the equity shareholders expect the return of 20%, 30% on a very higher side. So the company Apple Incorporation right now is having uh, even higher cash, but they still depend upon debt because this is cheaper and gives the tax benefit as well. Now Apple uses debt to fund its share buyback and dividends without reducing its cash pile. Apple have its cash with them only, and they use the debt sometimes to have the cash buyback or dividend buyback as well. As a result, what happens, its debt to equity ratio hovers around 1.5 to 2 times. So generally that is 1.5 to 2 times. If we see the Tesla company, so the Tesla company has very high debt to equity ratio, 2.5 times, because it has needed massive funding for factories, gigafactories. So they have taken a lot of debt. Investors accepted this risk because the company has a very growth potential and the Tesla company is profitable. This ratio dropped and finally they have paid or repaid back a certain portion of their debt. So that becomes very better. Now if you see the banking company just like JP Morgan Chase, others, then bank naturally operate in a very high debt to equity ratio because customer deposits are counted as the liability for bank, right? So these are the important things or factors about the debt equity ratio.